All right. Well, Gary, thanks for jumping in and doing this conversation with me.
You're very welcome.
I just want to start, I think, interestingly enough, you're the first guest other than Lauren that I've talked with on the podcast that I know way before business. So why don't we just kind of start there, like how we know each other and who you are, Gary?
My name is Gary Bettis. I'm an insurance broker, own my own firm in San Pedro. Been in business for approximately 45 years, seen many of the insurance cycles that we're facing now. And so we're dealing with all of the fire insurance issues, general liability, carriers leaving the state, all the fun stuff. But Anthony is somebody that I've known for, I shudder to say, at least 20 years.
At least.
A little longer. He was a young lad at the Boys and Girls Club where I've been a board member for close to 30 years. And it's been quite a pleasure to watch Anthony grow from the shy little kid to what he is today.
You said something that I think is kind of, it might be our through line of the whole conversation. It's the same, but only different.
Yes.
So how is this conversation around insurance and property insurance and risk the same, but only different?
That's kind of a loaded question. As everybody knows, the insurance industry in California was turned upside down about 3 years ago as carriers started to make noises about leaving the state. It basically boils down to inadequate rating. And it's, unfortunately, we live in a place where we have consumer advocates as our governments as opposed to regulators. And regulators are in a position to look at a particular industry, in this case, the insurance industry, to figure out how healthy it is for the rate-making process and everything else. Well, in light of what's happened over the last 5 to 6 years, wildfires have become a huge issue in California, and not just in remote areas. It's happened a lot in areas that are a little better populated.
Mm-hmm.
And in doing so, you have more people that are impacted by these fires. What just happened with Altadena and the Malibu and the Palisades fires was a little bit of an anomaly because there was the perfect storm there. You had the 100-mile-an-hour winds, whatever it was that sparked it, whether it was an Edison line or, somebody blew off a firecracker, whatever the case may be. It was at the point where they could not fight that fire because of the windstorm that was there. And, there's other issues that have been brought up, but by and large, that's the main reason. So that thought in mind, what's happened is the insurance companies are the ones that are paying for these losses. Insurance companies are built around their policyholder surplus or reserves. Okay. Those reserves are, hypothetically, you collect $100 in premium, you take $50 of that, put it into your reserves. The rest of it goes towards underwriting expenses. Well, if those rates are inadequate, you have to pay out more money than what you're taking in. All of a sudden, you have to be taking a hard look at the company's surplus or reserves to make sure that they have the ability to pay those losses once they come in.
You mentioned something about inadequate limits. Is that what, did I hear that correctly? Inadequate
rates.
Inadequate rates. So let's maybe slow down for people that are new to the insurance industry and maybe their only insurance coverage is their renter's insurance or their property insurance for a single family home.
Okay.
What does that mean, inadequate rates?
Well, it again comes back to the rating of policies. Insurance companies basically sell for a fee the ability to undertake the risk of replacing your property, replacing your car, paying for bodily injury or for liability losses based on a premium they take. They use actuarial data in order to come up with rates. In California, their hands are tied a little bit because the insurance commissioner's office does not allow them to use historical data, hence the wildfires that have happened over the last 4 or 5 years. They're forced to make their rate-making suggestions based on moving forward. They have to predict as opposed to...
Even though I think most of the population agrees we're experiencing global warming, that's contributing at some level to the fires that we're seeing. They can't forecast or project that like, hey, every degree that goes up, it's going to be this much more risk. They're not allowed to simply just use logic.
Correct. They can't, but historical data is one thing because areas that burn have a tendency to burn again.
Got it.
And it's just looking at the wildfire situation. It's the 1961 or 2, there was the big Bel Air fire. there was some very high dollar homes
Oh,
that
that
were
makes
destroyed in that particular area. Since then, there's not been a major fire there. So whether it has to do with the underbrush that was taken away or whatever the case may be, or better fire protection, a lot of different things. But using that historical data allows them to predict more of where it's going to be. Hypothetically, the area of the Palisades that burned, once it's rebuilt, they could probably safely predict that it would be another 20 to 30 years before they have the reasonable possibility of another similar action happen or similar catastrophe happen.
So I guess before we keep going down the dark and gloomy conversations that you and I have every time we talk, but let's maybe take it back. You said 3 to 5 years ago, this problem or these problems started to come about. But prior to 3 to 5 years ago, what was like the normal, stable property insurance environment like?
Looking at policies that we've had that have been canceled by other carriers, over the last 20 or 30 years, I know the company, initials SF, State Farm, they're canceling all of their apartment policies. What's happening now is by doing so, it's people that have had no claims, no losses, nothing. But because of the fact that nobody's writing those policies as standard carriers, the Allstates, Farmers, State Farm, Mercury Casualty, others, it has to go into the secondary markets, which is causing those premiums to skyrocket.
But couldn't you just argue that we're just talking about supply and demand, and it's not because insurance needs to go up, it's because the billion-dollar insurance companies get to charge more now and get to make more money?
Well, that's making more money is not the case. It's obviously they're in the state to make a profit.
Yeah.
Anybody that's in business is. But there's two components to the insurance industry. Hypothetically, you pay $4,000 a year to protect your $1 million home. What you're buying is the peace of mind that carrier that you're paying that $4,000 to is going to be there if you need them to write a check to pay your house if it burns.
Got it.
Where it gets interesting is that the insurance carriers, hypothetically, they take the $4,000, they put $2,000 in reserves, the rest of it goes to paying ordinary expenses, staffing, and so on. The reserve fund is there to pay claims in the event. So it's, hypothetically, you have your $4,000 house. The chances of your house burning down, statistically, based on the premium versus the risk, is very minimal.
And who determines what that reserve is supposed to look like? Is that the state or is that the business?
It's the state, it's the regulators.
Okay.
So they look at the total amount of risk and the amount of policyholder surplus or the reserve fund to make sure there's adequate money there to be able to pay. So that's where that comes into play. There's a secondary side to that, and that most insurance carriers, again, like we were talking, you have $1 million home and the carrier takes on the risk for the full $1 million. They will go out and purchase what they call reinsurance. Okay, reinsurance means is that the primary carrier, yours, that you write the check to, is going to assume half of that liability or half $1 million.
So that's the State Farm, the Farmers, everybody's that property owners are used to, or like commercial owners maybe used to like a CIG.
Yeah, exactly. And then behind the scenes, that carrier will go back and say, okay, we're going to reinsure part of our risk.
And hedge some of their own risk with somebody else.
Exactly.
Oh, wow.
Well, and what's happened with these wildfires that have happened over the last 5 or 6 years is that the reinsurance rates have skyrocketed as well as the rates that the general public is seeing.
Got it. And reinsurance, because they don't deal with the normal consumer, can they use forecasting and modeling and predictions?
To a certain degree, yes.
Okay. And so they're more, their numbers are probably more in line with reality than what the state's allowing for a consumer-based insurance company.
Correct. And many of the reinsurance carriers are not necessarily domiciled in California.
Okay.
So they could be outside, which they're subject to the regulations of their own
state
area of domicile.
Got it.
So it's sometimes California doesn't have a factor, but they're considered what they call non-admitted carriers.
So normal times, pre 5 years ago, you had a State Farm that could be your insurance carrier as a property owner.
Correct. What's
the reality today for like if a typical State Farm agency or just about any insurance agency today, it feels like there's 1,000 hoops that a property owner or a property manager needs to jump through to even have a
be
conversation.
able to find insurance.
Yeah.
Yes. Well, just a classic question that's being asked now. You decide to go buy a house, put it in escrow. What are the first questions they ask before they start escrow? Is, can you find insurance for this property?
So it's basically the equivalent of what used to be the conversation of, can you find a loan? Can you find a lender that will show us your pre-approval letter? So are we talking pre-approval letters for insurance now for escrow?
Basically, yes. It's looks like you have a loan contingency in an offer. This one it's not as formal,
Not yet.
but exactly. But there is a contingency in there for being able to find insurance, which basically gives the buyer the ability to say, throw up my hands. I can't find it, so we can't proceed.
Or I can't find insurance that's reasonable. There's some policies that we're seeing for our clients, or we're hearing in the media, that who in their right mind would pay for this policy? And sometimes it feels like you're better off to self-insure if you can afford to do so.
Right.
And you don't have a mortgage in place that would require you to have insurance.
Right. Yeah, it's a big risk to take. That's up to the individual to take that risk.
Yeah.
But, even in that sense, we've had a few of our clients that have done that as opposed to paying the premiums. But again, we will suggest to them strongly that they at least buy the liability side of it. Because
the trip and fall type insurance.
Exactly.
Okay.
Because the tort laws in California do not favor the business owner or the landowner.
Yeah.
It's all
We're talking, I think, generally just talking lawsuits. The reality of a lawsuit is that if somebody trips and falls on your property, it's not in your favor as a property owner.
Yeah, lawsuits that could basically come from nothing. We had one, this is probably 8 or 10 years ago, that came through our office where an individual broke into a business and injured himself climbing through the broken glass.
You're joking.
And sued the property owner.
And did he actually get paid?
He got paid something, a minor amount.
A nuisance, but a suit.
Yeah, just put it away. It got to the point where the insurance carrier had to look at it that it's going to be cheaper for us to pay him $5,000 or $10,000 than it is to spend $250,000 to defend it, to prove that we're right.
Wow.
So it's all dollars and cents.
It's a welcome to California moment for you as this owner or property owner.
And that's becoming actually more and more common.
Yeah.
Because a lot of the policies nowadays, especially on the professional liability side, a couple of others, where the defense costs are included in the limit of coverage. So, the response to that is that if you have $1 million policy, it costs $250,000 to defend it. You have $750,000 left to pay a judgment. You get $1 million judgment, $250,000 is out of your pocket.
Well, and that's only if the opposing counsel doesn't ask for a jury trial.
Yeah.
What if we ask for a jury trial? You're probably clears your $1 million right there.
Oh yeah, I mean, you saw the one recently that happened, the Starbucks loss.
I didn't see that one.
Oh, just the case was just settled.
Okay.
An individual was handed 4 cups of coffee. He was a Uber Eats driver or something like that.
Okay.
He was handed in a container 4 cups of coffee or hot liquid of some sort. When he accepted it, it fell. One of the lids came off and burned his abdomen area.
Okay.
And he collected $50 million. Or he got a judgment of $50 million. He has not collected it yet.
For an accident that he may have been some part in.
Right. And you look at it, and Starbucks
$1 million
has huge deep pockets.
Yeah.
So, that's
there was an attorney that was willing to chase after that $50 million.
Exactly, because they had the resources to do it.
So we're talking about, we have what used to be the reality was still not super rosy.
Right.
But it feels like there's been a few wake-up calls. We'll get to the most recent wake-up call this week that kind of was the impetus for our conversation today. But I feel like there's been a few wake-up calls even before this new, update this week. I'm thinking 2 years ago, we were already starting to see huge increases year over year or notices of non-renewal. What was causing that? Was it global warming and fire risk? It feels like there's also this issue of electrical panels that are no longer rated correctly and it was obsolete equipment. Like what caused the first layer of things to start to implode?
Well, you hit about 10 different reasons why.
Oh, so there's that many reasons.
Yeah.
It was all the above.
There's a lot of different reasons. The wildfire thing has been an issue in California for a long time. Over the last, as I said, 4, 5, 6 years, they've become more and more common and more severe. A couple of years ago, an entire town disappeared up north.
Paradise. Yeah.
Yeah. So the entire town was wiped out.
It would sound really well.
Yeah.
We had a Boys and Girls Club when I was managing those clubs in the North Valley. We had multiple Boys and Girls Clubs up in Paradise and in the Ridge, called the Ridge. They call it the Ridge in the community. So I remember, I think Lauren and I were on our honeymoon and we're seeing the international news that Paradise is gone. And I just couldn't fathom, how is that this entire town, this entire city's gone?
Yes.
And when the videos started to come out, it was just no question. Like, of course, everything's gone.
And again, it was one of those perfect storms with the wind and fire, a lot of fuel that hadn't burned in decades that just kept going. To answer the question, the first thing is the wildfires. The wildfires have been an issue for quite some time. So the insurance carriers, they again need to collect an adequate rate to be able to pay those claims and keep their reserves or policyholder surplus at a level where they can still pay for the protection that they're charging for.
And this is, I guess when these wildfires come in, it's not like your normal, I say normal, but your typical insurance claim where you lose one home or one flood.
Yeah.
These wildfires are taking out entire towns, their entire neighborhoods.
Exactly. And multiple dwellings, commercial buildings, the whole 9 yards.
That's the added risk of you're not just taking a hit. The insurance company's not just taking a hit. Their reserve is taking a multi-million or billion-dollar catastrophic loss.
What those wildfires have done is it's caused them to look more seriously at those areas that are considered fire hazards. They're looking for homes that have, probably a minimum of 150, 200 feet of what they call defensible area around it, which is where the brush is completely cleared. It's not a guarantee that the house won't burn. It just reduces entire chance. It helps.
I guess going back to the dollars and cents of business that we were talking about earlier. So you're saying the carriers are seeing the additional risk. They're taking these huge losses year after year with each fire season.
Correct.
It feels like the fire season is more like the whole year these days. It's not really a season for us anymore in California.
Right.
So that's why they're leaving the state or trying to leave the state.
Correct.
It's because they can't just leave, right? They're not allowed to.
Well, they can.
Okay.
But there's certain steps that they have to take to do that.
And are they able, if they decide, this year I'm not going to write a policy in California, if they change their mind next year, can they just come back?
Well, there's two different issues there.
Okay.
If they just decide we're not going to write policies for the next year,
okay,
that doesn't mean that they've left the state. It's just they made an underwriting decision that says that we're not willing to take any more risk on at this point.
Okay.
So they can come back and open that up at any time. To leave the state, it's basically like what State Farm did. They canceled all apartment buildings and some commercial properties and those kind of things. That was their decision based on their risk profile.
Got it.
So they got rid of those entirely, but they did not leave the state just for that particular line of business. You still write autos. They did not cancel the homeowners policies that were existing. They don't write new ones. And most of the carriers have taken that on as well. So Farmers, Allstate, Mercury Casualty to a certain degree.
I thought I read, or maybe you shared with me, I thought there were some of the big consumer-based insurance companies that were not only not writing new policies, but maybe considering terminating everything.
Considering, yes.
It's not a done deal.
Just not a done deal. It's still under consideration.
Got it.
So, there's a couple of the smaller carriers that have left the state, but it's insignificant in terms of, the broader picture.
Anthony A. Luna is the CEO of Coastline Equity Property Management, based in Southern California. As a respected Forbes and Fast Company contributor, Anthony shares insights that help property management professionals excel while giving back to their communities. His upcoming book, Property Management Excellence, will be available in 2025 on Amazon, Barnes & Noble, and bookstores worldwide.